as always. All right, Rahul Arora is now joining us. He's our market master of the day. He's, of course, CEO in Nirmal Bang Institutional Equities. Rahul, great to have you with us here. Thanks very much. How are you feeling about the market first up, Rahul? Are things changing at the margin a little bit from people trying to buy the dip to trying to once again, I mean, that old sell the rally kind of sentiment coming back? Not here in India so much so, but globally.
Morning, Prashant. Thanks for having me on. So I think from when we spoke in early Jan, I think 3 or 4 things have visibly changed. I think a lot has happened in the last 48 hours. I think the US president's surprise visit to Ukraine and Putin suspending the treaty, the arms treaty with the United States. So I think that the data point is old, but then the question is this going to have another refresh? And what impact could this have on global commodities? So I think that's the first. The other is the commentary that the Fed is expected to give out tonight, I think is expected to be higher for longer. And that could be a bit disturbing. I think the third data point is our very own CPI that came in, which was very disturbing. And I think now the market is probably factoring in another 25 basis point rate hike. And the fourth, I think, Prashant, is an entire earnings season's gone by. And we were just doing an analysis in our broking house. In fact, it takes off from what you were doing on the channel yesterday. And, we saw that about 50% of our stocks earnings have been downgraded. And about 20% have been maintained. It's only about 30% that have seen an upgrade. So I think a combination of an overall disappointing earnings season, a fresh refresh of what could happen in Russia and Ukraine, and the fact that inflation and interest rates is a bother both in US and India. I think this is going to cap any sort of upside. Now, could this become a sell on rise? I'm not entirely sure, but I don't think the market has any reason to go to 18,500 or even beyond that. I think if anything, a trade has to be taken now. I think it's probably more on the downside than it probably is on the upside. And the last data point I'd like to mention is, I think, because I look at the consumer sector very closely, I think if you look at consumer staples, consumer discretionary, consumer durables and electricals, the numbers in the last 4 months post-Diwali are coming off. So this quote-unquote wealth effect may also be waning at the margin. So I think the market needs some very strong positive data point to push it up. On the face of it, it doesn't seem to be there, which leads me to believe that the tilt could probably be more towards the downside than the upside.
The only thing with that argument is it's sort of like a consensus view, right? And the market never obliges with a consensus. So let's see how it shapes up. But for now, I take your point. I mean, when the world's largest retailer, Walmart, talks about a 2% growth next year, then wonder what's going to happen, lower down the cycle. But what do you do with consumption stocks then? Especially the guys who are present in the rural or tier 2, tier 3 cities. Do you avoid it entirely, or do you look for some opportunities here?
So I think the fact that layoffs are happening in most parts of the world is a reality, and that's going to have an impact on consumption everywhere. I think even if you have not been laid off, I think the fear of that happening, particularly in the Western economies, is very large. And I think one of the largest banks in the US, for example, yesterday has just put out, Morgan Stanley put out a note saying that they see the S&P falling by 26%. So when you have such kind of data points, obviously it has an impact on consumption. On India specifically, I think the volume growth was nothing to write home about in the third quarter's results. I think a lot will depend on government spending and the kind of projects they're able to announce and the labor it's likely to be generating. Hopefully, we have a good monsoon, but my sense is that probably the time to buy FMCG or consumer staple stocks will be after the next quarter's results. I still think they're priced for perfection. We've seen that in some of the consumer names and the impact they've had. The only interesting point, Sonia, and I think if I'm sure you tracked Manisha's link on CNBC the other day where wheat prices are off 30%. And for that, you've seen the impact on a stock like Britannia, which is doing well. So I think on a case-to-case basis, where you have reason for raw mat prices that are coming off and that's going to show you margin expansion, it's going to be great. But I think top line is going to be a challenge, and not just in staples. I think even if you look at beyond staples, stocks like V-Mart, Bata, they're all struggling on the top line growth at this point in time. So I think one more quarter probably, and then I would buy. I think it's a great proxy to the Indian consumption story is consumer staples. The kind of return ratios that they operate at and the kind of cash flows they have, only IT and FMCG in India have that. So maybe another quarter, and then I'd definitely look at entering consumer staples.
All right. Hi, Rahul. Talking about the consumption angle, my co-anchors have been talking about the scorching heat that we're bracing ourselves for. And there are a couple of ways to cool down, right? One is the air conditioners. The other one is beers, I'm guessing. What's your view on both these two pockets? Voltas has been doing well, and the numbers are very, very disappointing. It's been a big underperformer, but clearly there's some pre-buying that's taking place. If not at the stores, then at least on the share counters. Your view on the space?
So I think the summer has onset a little too quickly. I think even when I talk to my family and friends in Delhi, it started to get a bit warmer, which is a bit surprising for the month of February.
Yeah.
So obviously there's a lot of anticipation that inventory stocking is going to happen, and you'll probably see that growth come through, not only in the next quarter, but maybe some evidence of that in this quarter. I think for a lot of people, the point I was making earlier on consumer staples, I think in some pockets commodity prices have definitely eased off.
Yes.
And that's likely to probably aid margins. I think we'll probably look for players that are gaining market share, something like a Blue Star, which has definitely given out a printed market share, target that they have, and they're already at about 13.5%, 14% or there and thereabouts. So I think on Voltas, obviously the people are waiting for the demerger to happen if and when it happens, and I think then the consumer business will probably get re-rated dramatically. I don't know if and when that happens, but definitely we'll look at names like Voltas and Blue Star. Maybe Blue Star more than Voltas. I think the return ratios are also picking up dramatically for Voltas, for Blue Star, and I don't think the valuations are demanding at all. So I definitely look at those two. I would probably avoid the Whirlpools and the IFBs because I think the presence in air conditioners is much, much lower. They're slightly more hardcore refrigerator and washing machine plays, but I'd look at those. On the liquor side, I think United Breweries was really, really disappointing on the results. I think, I can't remember the last time they came out with such a bad set of numbers with margin compression. My tilt would probably be more towards United Spirits at this point in time. I think United Breweries is going to struggle. There are route to market concerns in both entities. I think in United Breweries it's showing up a little bit more because some of the key markets, particularly in the south, have changed their route to market, and that's going to have an impact on business and volume growth. But I think if you look at the return ratios for UB and UNSP, they're probably half of what a consumer staples is, and the valuations are not too different. So I think probably if I was to take a slightly more structural call, I'd tilt a little bit more towards staples than towards liquor. But for the AC manufacturers, for sure, and I'd probably say Blue Star 1, Voltas 2 in that pecking order.
So you like ACs and you like beer. That's a great combination.
They're not essentially mutually exclusive. You consume one in the presence of the other in most cases. But, I think, like I said, I think probably United Breweries would probably be an avoid for some time. UNSP, I'd probably look at nibbling in at dips. But Voltas and Blue Star, I'd definitely look at buying even right now.
Yeah. And this, the headlines on summer, it's like, it's almost every year. I mean, the onset of the summer is earlier this year. I mean, I think you can find that same headline, for the last 10 maybe. But I don't know. It perhaps is, global warming and whatnot. But let's come back to specific stocks, Rahul. You guys put out a note of Minda Corp, right? Not very enthused by what they are trying to do. And I completely agree with that point. Just, you want to talk about that? What's the rationale, what's the reasoning, and how do you look at that transaction?
So I think what they're trying to do is the right thing. I think the way they've probably gone about doing it is probably, a question mark. I think any company that has cash on books, either you invest that capital into your existing business and grow it, or you look at an adjacent business to acquire and sort of, grow your business that way. So either organic or inorganic. But I think while the Minda Corp management says that it is an ancillary business to them, and it probably makes sense because they are a competitor. I think a financial investment in another auto eyeing company, I'm not so sure. If they had come in as a strategic investor and business partners, it would have made far, far more business sense. I think I'm not sure. So now the fortunes are linked to the stock price of pre-call, effectively. And our call is that at a time like this, could there have been a better investment for that money, as simply put as a fixed deposit for that matter, or a 10-year GSEC where you could have got the yield on that. So, when you're a financial investor, you're basically a stock market investor. And I don't think that's probably the best use of capital. See, it's a 28% return on capital employed business is Minda. The return on equity is about 16, 17 times. And before this deal happened, I think the valuations were at about 14 times. So it was not like it was coming to you at a substantial discount to many auto component companies. Some that have a larger export-oriented thrust, like a Sona or an Endurance, etc., will probably go at higher multiples, but they have their own challenges to deal with in Europe. But I think the fact that it's now by and large linked to the stock price of pre-call, as opposed to taking a business interest and having a seat at the table, we just felt that for the kind of return ratios that they had and the kind of capital allocation that they've done, a slight P tweaking was required, and therefore we had to change the view on the stock. Obviously, if the stock price of pre-call does well and they get their return on investments, but then it's like playing IT for rupee depreciation. Is that what you want to buy it for? Okay. That's the thought.
All right, one last question from my end, because the flavor of the season is weddings, right? I mean, the kind of hotel bookings, airline travel is at a record high, and we've seen this whole wedding season sort of blow up, I think the highest in the last 4-5 years. This space, whether it's hotels, aviation, do you think it's good just for a trade, or is there some long-term potential here?
So I think the businesses are definitely into a new orbit, but I don't think they have room to squeeze from here, particularly on rates. I think if you look at the listed entities, right, which is the Taj Group, which is Indian Hotels or East India Hotels through Oberoi, and even if you track the other room rates just on Make My Trip, which is something that we do, I don't think the hotels have too much room to increase ARRs, and I think the cost savings have by and large been factored in. Even for aviation companies, I think they're not going to be able to push too much more on price increases from here. So it's basically going to be on cost savings and operating leverage that comes through as a result. Paying 23, 24, 25 times 1 year forward EV EBITDA for these guys now looks a little tricky, because I think the trajectory, as I was saying a little earlier, I think if you see consumption trends coming down post Diwali, you know, I'm not sure that these kind of numbers can potentially sustain. Hotels are a cyclical business, and I think an entire cycle has got captured too early in the stock prices of these entities, right? Indian Hotels went from 70 to 350 in a matter of 18 months. So I think for a lot of these guys, the best may be behind. I'd still probably, if you're looking to play discretionary, move away from hotels and aviation to certain QSR players that have actually underperformed. And I think that may not be a bad way to look at it, because I think the return ratios and the valuations in QSR are a little better than they would be in some of these other discretionaries like airlines and hotels. So if you've made your money, I'd definitely look at making a switch there.
And I think you made that point the last time as well on hotel stocks. Maybe the best is behind. I think some of them have corrected from the top. So good on you. Thanks so much, Rahul, for coming down to the studio and in fact giving us your view on a whole host of sectors as well as the approach to the markets. Well, let's shift focus then to another theme. Cement stocks, they've been moving